times have we heard of top Indian IT companies buying back their shares? Quite a few times, right? But what's the rationale behind this? Why do they want to use their free cash flows to buy back their shares? Are they running short of growth opportunities? And once the investors apply for these buybacks, how does the entire process work? These are some of the questions we're looking forward to answering in this article. So let's understand this with the Infosys buyback. The company announced its buyback at a maximum share price of 1,850 per share. And the size of the total buyback is 9,300 crores, their biggest in the last 3 years. This 30% premium is vis-a-vis the price on which the buyback was announced, that is 13th October. Now, Infosys has made this an open market offer and not a tender offer, meaning that the purchase that they are going to do is from the exchange directly. And 1,850 is the maximum price at which they will be buying back their shares from the exchange. So as an investor, during the entire period of the buyback, you can sell the stock on the exchange and the company can buy it from there. The other kind of offer is the tender offer, where the company ascertains the price at which they are going to buy back their shares. Mind you, it is not the maximum price but a guaranteed price. For instance, if the Infosys buyback would have been a tender offer, 1,850 would have been a guaranteed price that the investors would have received. But in this case, it is an open offer, hence the case of maximum price. Now that we know how the buyback would work, it's time we understand why IT companies frequently do buybacks. The answer lies in the business model of IT companies. They are asset light, that is, their money does not get blocked in fixed assets or working capital for that matter. If they do good business, naturally they will be making a lot of free cash flows. Now, there are two ways of rewarding the shareholders with the free cash flows they have. One is through dividends and the other is through buybacks. Dividends are something that is in a way mandatory for all investors to take. You don't really have a choice there. And also, dividends have a negative impact on the stock price by the amount of per share dividends. On the other hand, in the case of buybacks, since the company announces the buyback at a premium, the share price generally rises, as we are seeing in the case of Infosys. The share price rose from 1,420 to 1,570. Also, buybacks are optional. They are not forced upon, as we saw in the case of dividends. Buybacks also help companies boost their EPS, as buybacks reduce the number of shares available. In the case of Infosys, almost 5 crore shares will be out of circulation, hence giving a big push to the EPS of the company. Do you think buying back in open markets could turn out to be unfair for the investors as the price is not guaranteed? If your answer is yes, your thoughts are pretty much aligned with the Securities Exchange Board of India. They actually want to end the system of open market buyback by 2025. The tender route might be the only route post 2025. 197 Communications has also announced its buyback at a maximum price of 810. Since we have already written it is the maximum price, we need not mention the type of offer it is. The company IPO'd last year at the price of 2,150. The stock plunged to as low as 450. So agreeing to buy it at 810 showcases that the stock is undervalued. This buyback is very different from the Infosys buyback. The junction at which Paytm is, it definitely needs to send this message to the investors that the stock is undervalued. And the company wants to drive positive sentiment among the investors, especially the retail investors. Goes without saying, the price shouldn't be the deciding factor when you decide to participate in a buyback. But rather, it should be the company and its history of corporate actions that would help you judge these actions better. Hope you found this video insightful and that you might have gotten an idea of how a buyback offer works. If you found this piece of information insightful, do not forget to subscribe our channel so that the YouTube algorithm works in our favor. Also, do not forget to hit the like button. See you.